Good evening, everyone, and welcome to today's exclusive webinar, Beat 2025 Volatility Inside 361's Multi-Asset NFO. And today, we're thrilled to be joined by Mr. Raghav Iyengar, CEO of 361 Asset. With over 30 years of experience in the financial services, Mr. Raghav leads the firm's business strategy, product innovation, and market expansion. Prior to this, he held leadership roles at Axis AMC, ICICI Prudential, and Tata Asset Management. So welcome, sir, and over to you.
Thank you so much, Jeff. How are you doing?
Very well, thank you.
Great, super.
So what we're going to start off with is we're going to keep a little bit of a conversation.
Yes, that's the way it should
and we're going to ask you a couple of questions.
Okay.
So according to you, what exactly is a multi-asset allocation fund?
So to put it very simply, it's a sleeve or a scheme which puts money into different asset classes.
Okay.
So as you know, mutual funds can invest in equity, fixed income, commodities, REITs, InvITs, and foreign equities. This is a fund that actually takes all these asset classes into one scheme.
Okay.
So if I'm going to put it, it's a bit of an all-in-one scheme.
So why has 361 launched such a fund and at this time?
So that's a great question because I think what we've seen over the last 3-4 years is a lot of volatility in the market, right? And that's happening due to interest rate movements, geopolitical events, lots of the trade issues. So there's essentially a lot of flux in the market today. So we believe that investors need a lot of options to invest money. Very difficult to predict which asset class will do well at what point of time. So that was the fundamental central thought of launching this product. And because these asset classes tend to move in very, very different directions. So if you're able to get that right, I think the investor experience will be pretty good.
So which assets does this fund actually hold and why? And what are you looking at coming up with this kind of a fund this right now?
So if you see the offer document, which is essentially the mother document of this fund, right? The equity allocation will be between 15 and 35% of the portfolio.
Okay.
Right? The commodity allocation, which is essentially gold and silver, will be between 25 and 40. Okay. And debt will be between 10 and 50%. We also have a sleeve out for REITs and InvITs, which is anywhere from 0 to 10%.
Okay.
Now, as I said, the reason we're doing this today is it's very, very difficult to predict tomorrow's winner, right? And most of these asset classes move in very, very different ways. So just to give you an example, 24-25, you had equities giving you tepid performance with low single-digit returns on the index. But you have, let's say, gold, for example, doing quite well and silver doing very well. So essentially, this product tries to balance out returns in various asset classes because what the investor is really looking for is a less volatile return. And that's what this product aims to do.
So this is a balanced portfolio for investors looking at for the long term.
Absolutely. I mean, if you remember the old Hero Honda ad, I'm just to repeat it, it's a sort of a fill it, shut it, forget it portfolio. Because effectively, you're getting up all the assets that you can get in one scheme. And you have a professional fund manager trying to balance out assets out at various market circumstances to give the investor the best or the optimum investment outcome.
Okay, so this kind of answers my next question of how does this blend cut risk for me?
Right. It does because, as I said, in the various investments move in different directions. Right. Typically, when equities don't do that great, you have fixed income, which is debt, and commodities doing much better, and vice versa. Right. So this gives you reasonably large allocations to the three big asset classes, which is equities, fixed income, and commodities. And in this case, commodities for us is gold and silver. Right. And ideally, an optimum mix of this in the percentages that I spoke about in my previous question should give the investor a reasonably low volatile return. Which I think is the need of the hour today, because there's so much of uncertainty in the air today. Right? Everyone knows that equities are a great long-term investment, but you need to stay invested and be patient. Many investors are unable to cope with the volatility that it gives you. So this product effectively tries to reduce that volatility, at the same time not compromise the return.
So there was a hypothetical riskometer.
Yeah.
Where would this fund actually sit on the riskometer?
This is a high-risk fund because it has an exposure to equities, it has an exposure to silver, which are typically volatile investments. right? But it will be a step lower than traditional equity instruments. So I would put this somewhere between fixed income debt and between pure equity. So it actually sits right in the middle.
So, according to you, this fund, who would the ideal investor be for this kind of a fund?
Well, that's a lovely question because in my earlier, I would typically say anyone who wants a lower volatile return on his investment. So I think
Okay.
if you're an investor who's comfortable with negative returns over a
Mhm.
long period of time, or used to, or you're okay with seeing minus 10, minus 20% at points of time in your portfolio,
Mhm.
maybe this product is not for you. Maybe that's the product, that's the one that goes to equity. But a lot of investors, especially first-time MF investors, people who are looking to build a corpus, maybe someone who's getting into retirement age, maybe retired people who are looking to invest in a portfolio which will give you better than maybe an optimum return. All these are potential investors who can come into this fund. So it satisfies a whole lot of investors, right? From somebody who's starting their investment portfolio but doesn't want the stress of too much volatility, all the way to maybe, let's say, a retired investor who's looking for more stability in his portfolio and is not comfortable with too much of drawdown. So it, as you can see, it sort of encompasses a very, very wide spectrum. So, but just to sum it up, I think first-time investors, maybe retired investors, even people who are approaching retirement, people are looking to build a good, healthy corpus. These are people who are an immediate investment possibility.
So, this is not technically only for somebody who has surplus that they want to put in.
Oh yes, yes.
So, how does the fund decide when to rebalance their complete
So
list of
as you
assets?
know, we've got three specific fund managers to run this, portfolio managers, because each of these are specialized investment classes. So we have someone who runs our equity portfolio, is a gentleman called Mayur Patel. He looks at our entire equity investments across the mutual fund. We have a gentleman called Milan Modi who looks after our entire fixed income. So he looks after the fixed income bucket. And we have a third gentleman called Rahul Ketawat who looks after our commodities portion. On top of these people is our CIO, who's Anup Maheshwari. He comes with over 2.5, 3 decades of investment experience, been through a lot of investment cycles. So under his guidance, and we typically will have an asset allocation kind of a committee, which then sort of looks at data, looks at where flows are happening, what's the political issues, what are how are corporates doing, and a whole lot of other economic data. And then that asset allocation committee typically tries and tells you the fund management team as to what should go into what bucket. And then it's after that the execution is left to the individual portfolio managers. So that's the discipline that we've instilled into this product, because it's not a single person running this. It's actually three different people running their parts of the portfolio.
So, according to you, what benchmarks will you all use to judge the performance of this fund?
Yeah, so I think we have a composite index. As I said, this is a combination of 3, 4 different asset classes. So we plan to use a BSE 500 TRI, which is for about 25% of the portfolio. We have a composite gold and silver index for about 25 to 30% of the portfolio, and the balance will be a fixed income benchmark. So combination of these three will be the benchmark.
If a person needs to, who's going to be entering once fund opens out and closes, and uh, how long would you suggest that somebody stay invested with 361 fund?
See, ideally, the saying is that the patient investor is the one who makes a lot of money. That's what the data is shown us. So, but ideally, someone with at least 3 years of investment horizon should look at this fund. Please don't treat this as a trading oriented fund, because that's not what it aims to do. So somebody who's got a 3 year plus corpus or 3 year plus time horizon and wants to build a substantial corpus can come in and start looking at this fund. There's no top end. I mean, I won't say 3 to 5 or 3 to 7 or anything, because to my mind, that the end goal is very, very different for different investors. Somebody may need money after 5 years. Some people may not need money at all for 10, 15 years. This product, in that sense, fits that bill. But broadly, it is a fund again which tries to minimize volatility by using a combination of these three large asset classes and tries to give you, the investor, a great experience.
Just getting a little bit technical. So, are there any charges with the exit load and any ongoing expenses that will come with the fund?
Yeah, so the fees are as prescribed by SEBI in the mutual fund schedule. Right? So there is no exit load. I'm sorry, there is no entry load, as you know. There is an exit load of 1% if you were to redeem before 12 months. But there is also a caveat that if you redeem up to 10% of your portfolio in the first year, also there's no exit load. So the first 10%, there's no exit load. Beyond that, if it crosses 1 year, then there's no exit load. If you take out before a year, there's a 1% charge.
So, if you could just help our investors and our viewers understand how will their returns be taxed?
That's a lovely question because anything now in the new taxation bill, more than 36%, or rather, debt has to be less than 36%, less than 64%, uh, will get taxed at a concessional rate of about 12.5%. But the period of holding has to be for 2 years. And then it gets taxed as in the law, it gets categorized as a long-term capital gain. If the investor holds for more than 2 years, then it's taxed at 12%, 12.5% plus whatever applicable surcharges are there. So it's a very easy taxation rule. So somebody comes in, holds on for 2 years plus, takes out whatever part of the money, whatever gains are there, if any, are taxed at straight away 12.5%, which is very concessional in today's income tax environment.
Okay. Now, a little bit of a different question.
Yep.
Now, let's imagine somebody is around 30 and they invest about, say, 5-10,000 rupees a month. And does this belong to your core bucket, or would this belong to their satellite bucket for them?
I think this is a core investment because very clearly, as I said, we're trying to take three of the biggest asset classes available today, which is equity, debt, and commodities, and try and package it into one fund. So I think that, to my mind, should be part of your core allocation. Because an investor does need exposure to all the three asset classes. And what this does is, by that formula of the asset that I told you, it gives you meaningful exposure to all the three asset classes. So without you really stressing yourself about which asset class do I go to, how much do I put, when do I put in, when do I take out, in some sense, this fund solves that problem. I think it's absolutely core. So whether you're a 30-year investor or you're just somebody who's starting out, maybe your first job, but you're not comfortable with the kind of volatility that is present in the markets and especially in the equity space, I think this is a great place to start your life.
Now, let's say somebody is going to retire in about 5 years. So, what kind of returns should they expect versus an equity-only fund?
So again, equity, as you know, is extremely volatile. So obviously, the last 3, 4, 5 years, especially post-COVID, returns have been very healthy. But there have been periods, and data is there to show that for long periods of time, equity has given a negative return, has also given you zero return. Right. So if you're somebody who's going to retire and who needs a corpus after say 4 or 5 years, then obviously this fund is maybe more suitable to you because it's sort of the predictability of the returns is better in this fund as compared to a pure equity fund or maybe a pure commodities fund or maybe just a pure debt fund, because it just tries to optimize the three assets to give you the best outcome.
Is it possible for somebody to actually pause or resume or stop their SIPs in this fund at any
Oh
point?
yes, anytime. I mean, it's a very, very simple process. See, that's the beauty of SIPs. I mean, they give you tremendous flexibility. So you can start, stop anytime. You can top it up, and you can pause it right now for about 3 months, because there are circumstances we understand where an investor is not able to put that monthly investment. Every investor has their own complications. So we try and make this as flexible for the investor as possible. So all those things which you talked about, all three are easily possible, no problem.
According to you, how liquid is this fund and how easily can somebody get their money back?
I think that's a great thing about the whole mutual fund segment, and especially in this fund, because typically you can redeem on any business day, and typically people give you money back in about T+3, T being the redemption day, provided you give us the redemption request before 3 o'clock. So within 3 business days, typically the money hits your bank account.
How is this different from a balanced advantage or a BAF, or compared to a hybrid equity fund?
So the fundamental difference there, Jeff, is that BAF typically will give you asset exposure only to equity and fixed income.
Okay.
Multi-asset, as the name suggests, is typically equity, fixed income, commodities, gold, silver, in which REITs, and also whenever we get an opportunity, maybe foreign assets, foreign equities too. So it's, in that sense, it's a pretty much a composite investment proposition for the investor.
So, according to you, is it better for some investors to invest via SIP, or would you suggest lump sum
It depends on the investor, Jim. So if somebody's got lump sum, I would say please put it in. If you're stressed about what's happening in the market, maybe put it in 2, 3, 4 installments. That's also easily possible through a systematic transfer plan, or you can just give additional purchases whenever you want. Somebody who's starting off the investment journey, but again, as I said, uncomfortable with volatility, not very thrilled about markets going up and down. Again, you can do it through the SIP route. So completely up to the investor. I mean, but if I had lump sum money, I would put it.
And for our overseas clients, can NRIs invest into this fund as well?
NRIs, okay, there's the provision is that you have to be investing from what we call a FATF approved destination. FATF is the Financial Task Force. So they prescribe a list of countries where investors can come from. And there's some where obviously they can't come from. So as long as you are there from those FATF approved countries, NRIs can happily put money, no problem.
I think this kind of gives us a complete understanding of the entire fund, and we really appreciate you coming out here, sir.
Thank you.
For
My
coming into
pleasure.
our office.
My pleasure. Thank you so much for giving me this opportunity. Thank you.
Thank you so much, Mr. Raghav Iyengar, for walking us through the strategy, structure, and the real-world thinking behind the 361 multi-asset allocation fund. From understanding how the fund balances equity, debt, commodities, and REITs, to exploring stress test scenarios, tax implications, and post-launch metrics, you've helped us see how this product is designed to thrive in a VUCA world and adapt to real market conditions. So to everyone who joined us, thank you for being part of this conversation. We hope this session gives you clarity and confidence to think more strategically about your asset allocation in your portfolio. So until next time, happy investing.